Hello, folks, and welcome to this series where we explore the wonderful, confusing, sometimes scary world of derivatives. Now, don't worry, this is the first video. So, today we are not going to do any crazy math, no formulas flying at your face, just definitions and core ideas. Think of this video as the warm up stretch. Very important, very underrated. So, let's start with the most basic question of all. Why do derivatives even exist? My simple answer: derivatives exist to transfer risk from people who can't afford it to take risk to people who actually want to make money by taking risk. That's it. That's the whole idea. One group says, "Bro, I just want stability. Please don't surprise me." And the other group says, "Surprise me. I like dangers. I like profit." Derivatives are actually the middleman making the deal happen. And once you understand this, everything else starts making sense. So now that we know why derivatives exist, let's answer the next obvious question. What exactly is a derivative? At its core, a derivative is actually a contract whose value depends on something else. Yeah, it's basically a dependent child. More formally, its value is based on an underlying asset. Okay, think of it like this: contract to buy or sell something with some fixed terms and conditions. No drama, everything decided in advance, and that something, that underlying asset, it could be a stock, a currency, a commodity, or yes, even interest rates. Now, let's understand this with a simple example. Just two people, no Wall Street, no shoots. First, we have a farmer. The farmer grows wheat. He works hard all year and after harvesting, he will sell the wheat in the future. But there is a problem. What if by the time he sells the wheat, prices fall? That uncertainty scares him. On the other side, we have an airline company. The airline will need to buy fuel later, but it has its own fear. What if fuel price suddenly go crazy and spike up? So now notice something interesting. The farmer is scared of price going down. The airline is scared of prices going up. They have different businesses but same headache, uncertainty. To solve this uncertainty, a forward contract comes into the picture. A forward contract, which is a type of derivative, we will discuss it properly later, basically says relax. No worries. To the farmer, it says no matter what happens to wheat prices, you will sell your wheat at a fixed price. And to the airline company, it says no matter what happened to fuel prices, you will buy fuel at a fixed price. Now look at the result. The farmer has guaranteed income, the airline has fixed costs. Both have removed uncertainty from their lives, and yes, now they can sleep peacefully at night. Now that we understand the basic idea, let's zoom out a little. In the world of derivatives, there are four main types. You can think of them as the four pillars of derivatives: forwards, futures, options, and swaps. Don't panic, we will see them one by one. So let's start with the first one: forwards. According to John Hull, a forward contract is an agreement to buy or sell an asset at a certain time in the future for a certain price. In very plain language, a forward contract is a private, customizable agreement between two parties. Nothing fancy, just two people agreeing on terms. Let's understand this with an analogy. Again, a farmer and a buyer. The farmer agrees to sell 1,000 kilograms of wheat at a fixed price of $200 after a fixed period of time. Everything is fixed, price is fixed, quantity is fixed, time is fixed, and this contract is customizable because it's private. That just between these two people. But here is the catch: because this is a private agreement, there is a risk involved. What if one party decides to back out? What if someone defaults? There are no exchange standing in the middle, so if one side defaults, the other side bears the loss. That's the key risk in forward contracts, default risk. And this small problem will lead us naturally to the next type of derivative, but we will get there. All right, now let's move to the next pillar of derivatives, futures. According to John Hull, a future contract is a standardized agreement to buy or sell an asset at a future date, traded on an exchange with daily settlement. Now let's decode this sentence because it sounds scary, but it is actually very logical. The first word was standardized. Unlike forwards, you don't customize everything here. Quantity fixed, quality fixed, and delivery date is also fixed. You don't negotiate, you just choose from what the exchange already offers. Second word was exchange traded. This contract is not private anymore. It is traded through an exchange. So no more trust me bro contracts. The exchange stands in the middle and supervises everything. Now comes the most important part, margin and daily settlement. When you enter a future contract, you don't pay the full amount. Instead, you open a margin account. Every single day, your profit or loss is calculated and settled immediately. The daily adjustment is called mark to market. So losses don't pile up till the end, they are settled daily. And because of this daily settlement, the risk of default drops dramatically. That's why futures were created to fix the biggest problem of forwards, default risk. And the small upgrade changes everything. Alright, now let's talk about my favorite one, options. According to John Hull, an option gives the holder the right, but not the obligation, to buy or sell an asset at a specific price. Right, but no obligation. And that single sentence changes everything. An option can be of two types, a call option, which is the right to buy, and a put option, which is the right to sell. And there is one important thing here, options are not free. You have to pay cost upfront called the premium. Think of it like an entry fees. Let's start with a call option. In a call option, you have the right to buy an asset at a fixed price. If the market goes above your contract price, great. You have the option to make a profit. You use the option and make a profit. But if the market price stays below the contract price, you simply walk away. The contract becomes worthless, and your maximum loss is just the premium you paid. Losses are limited now. The put option is the opposite. Here, you have the right to sell an asset at a fixed price. If the market price falls below your contract price, you profit, but if the market price goes above the contract price, you don't use the option. And again, you only use the premium. So in option, your downside is limited, upside is open, and certainty becomes manageable. And that's why options are powerful. All right, now let's talk about the last pillar of derivatives, swaps. According to John Hull, a swap is an agreement between two companies to exchange cash flows in the future according to a pre-arranged formula. So at its core, a swap is simply an exchange of cash flows. Nothing physical is exchanged, only money flows. Most commonly, one cash flow is fixed and the other is floating. And basically, both sides are making a bet on how that floating rate will move. Let's understand this with an analogy. Imagine two companies, Company A and Company B. Company A is paying a fixed interest rate of 4%. Company B is paying a floating interest rate linked to LIBOR. LIBOR is just a benchmark interest rate used by major banks. Now, some of these two companies enter into a swap agreement for 3 years. They exchange their interest payments. Company A pays based on fixed interest rate, company B pays on the floating interest rate. But instead of exchanging full amounts, they calculate the net difference. Whoever owns more pays only the net amount to the other company. So here, one company benefits and the other pays. If floating rates go up, one side wins. If floating rate go down, the other side wins. That's a swap, structured, planned, and all about managing interest rate risk. So let's quickly recap what we have learned today. Derivatives are not scary weapons of mass destruction. At their core, they are just simply tools for transfer risk. People who want stability can pass risk to people who are willing to take it for profit. We saw derivative is just a contract whose value depends on something else, the underlying asset. Now, after that, we saw four pillars of derivatives. Forwards, they are flexible and private. Futures, they are standardized and safe. Options, they give us right but not the obligation. And swaps, they are agreements to exchange cash flows. We saw all this without complex math, without formulas, just the logic behind why these instruments exist. So, here is the interesting part. So far, we have talked about what derivatives are, but we haven't talked about who actually uses them. Because not everyone in the derivatives market has the same intention. In the next video, we will meet the players of the derivative market: hedgers, speculators, and arbitrageurs. Once you understand these three players, a lot of market behavior will suddenly start making sense. So, if you want to truly understand derivatives from the ground up, make sure you subscribe the channel so you don't miss the next video. If this video helped you even a little, hit the like button. It really supports the channel and tells YouTube that this content is worth sharing. Thanks for watching, and I will see you in the next video.